Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, July 16th, 2021. We've got the S&P 500 currently sitting at 4344. We're recording this before close. I'm David Darling. I'm here with a man who never cries over spilled Coca-Cola, Ian McMillan. We have some change, but not change this week, Ian. Where should we take this thing?
I feel like it's been the same story. We can get on here and talk about red flags, crappy participation, risk on areas starting to overtake risk off areas. For example, utilities outperforming Bitcoin and making a new relative high. But there's plenty of red flags. I think that the technical community has done a good job at pointing those out since March, but we're like 1% from all-time highs. So
yeah, we're 1%.
Hasn't really showed up.
Yeah, it's 1% from all-time highs on something like the S&P 500. Meanwhile, about 30% of the stocks in the S&P 500 are down at least 10%, which goes back to that mega cap theme that we've talking about when you've got Apple and Microsoft and Amazon doing well.
Now, is that down 10% from their year-to-date high?
Yeah, from their peak, not from year-to-date January 1st, but from their peak.
Just from their peak in 2020?
Yeah,
okay.
Correct. So that just goes to show the thinning that's going on. And I know you guys have done great work, whether it's looking at micro caps and small caps and their relative performance. Whenever you have those areas underperforming the S&P 500, it's a narrowing market. There's less and less stocks participating. That's just the fact of the matter. And was this an important week this week? Are we looking 6 months from now and saying, remember that top from mid-July 2021? Who knows? We have to break some levels first.
Eventually the major indices would have to break down.
We do, we've talked plenty of times about IWM at 234, could not do it. At the same time, on the flip side, we've seen plenty of demand in something like IWM between the 208, 215 level. Do buyers show up there again? I think that's going to be, because if the Russell 2000 were to close right here on Friday, this would be the lowest weekly close going back all the way to end of January 2021.
And I was going to bring that up. This would be, I don't know if you want to call it a change in behavior, but this would be
yes
at this level for months on weekly candles. We have finished well off these levels.
Yes, I know exactly what you're saying. Since January, the area we're in right now, using something like IWM to represent,
a lot of demand.
Has seen demand show up consistently for 6 months. To your point, what you're saying is, if we don't get that going into this close, that is a change in behavior.
Yeah, that would be weekly close. It would be, I would consider it a breakdown, but you would be closing below where we were on May 1st.
Yeah, at least on a weekly time frame for sure. And then you started getting into, I know this is a little bit of shop talk, and I know this portion is reserved for our clients, but you get into double top type conversations then from a weekly time frame. And that phrase means what it means. We would be closing at a new low. That would be confirming what technicians, those who study supply and demand, price a double top potential. If we're closing below 217.70, that's a little bit of a problem for small caps and for the broad market.
And I would say it's a similar topping pattern to July, August, kind of the same time frame that we saw in 2015. March through July, and then it ends up breaking down in August.
Sure.
And
Absolutely.
obviously we now, traded lower on into, now this is small caps in particular I'm talking about. But yeah, from uptrends, consolidations from uptrends usually see the trend continue in that same direction. That may not end up being the case. I will say the Bears have had a lot of chances to do something. I mean, Bulls have too. There's not really a lot of conviction on either side.
Yeah, with all these
is
ranges,
hiding
for
out
sure.
in Apple and Microsoft really conviction on stocks? I don't think so.
If you're right, if you're managing a lot of money, those are logical names to go towards for liquidity. And when you mentioned a little bit earlier, when you're seeing things like utilities, which is typically a conservative or safe haven, outperform something that's high risk like Bitcoin, we're seeing a lot of these risk on, risk off ratios similar to that, kind of signaling some potential issues ahead here.
Well, and, to be totally transparent, I'm sure a lot of clients hear that and they say, well, you guys own Apple right now. Yeah, that's the point. I'm I'm not lying. Like, I'm not here to tell you I have a bunch of conviction and I know where the market's going.
Well, and when we use relative strength,
yeah,
there's some clues there on where we should be. And when the market's thinning,
markets are going up and
right.
everyone's you got to participate, right?
Exactly.
And that goes back to the whole argument. And there's been a lot of, wouldn't have this just been an easier year to hide out in cash? No.
S&P is still up.
Not if your benchmark is anything related to a broad market index.
I don't think we get to say that.
Has it been a grind? Yeah.
We're a percent off the highs for the S&P 500. So the S&P 500 is about up 15% year to date. Are we really sitting here going cash is where we need to be? Now, I will admit the warning signs are here. We've talked about them ad nauseum. If we're below 4320 on the S&P 500, with things already being narrow, we could see a healthy correction go in from this point. And healthy, because every year has a standard average correction of like 8 to 10%. So it's not like,
or this is the other flip side to this. I still think has to be, right? We still got the second half. We're 2 weeks into the second half of the year. We have a long way to go.
Absolutely.
A lot of alpha to be made and lost, potentially. Or is this just another 2017?
Right, where we just keep grinding.
That's the other flip side, is that growth does take over dramatically. And, this just ends up being a year where it's December 31st. The S&P's up, whatever it was, in 28%. And
yeah, that's always a possibility. The difference would be that the breadth wasn't this thin and the volatility was lower, but your point is made. Your point is you can't close your mind to that possibility because the market gets to do what the market wants to do. It really does not care what Ian thinks. It doesn't care what I think. If we think, wow, the market's really thin and this thing needs to correct, it doesn't have to do anything. It doesn't have to listen to that. And so your point is valid. And on the flip side, if we get a 7% correction from the highs, that only takes us down to a very logical level near 40.67. And when I say only, I don't mean to sit here and say that minus 7% feels great. I'm just saying that's a very logical level where you could correct to and still be within a broader time framed bull market. Who knows?
I bet that would be a pretty loud. It's already loud. And look how we're 1% off the highs, 120
Correct.
basis points off of the highs that all-time highs we just made 2 days ago.
Mm-hmm.
And I think there are a lot of people standing around on both sides.
And when you say both sides, you mean bull bear?
Bull bear.
Stocks go higher, or stocks go lower. Camp.
From a fundamental technician, also kind of divide of a lot of people standing around. No one's hitting the sell button. We all see the cracks in the foundation, and nothing's really happened yet. Now, I will say one caveat to that, and just an interesting note. 2020 was a year of the macro picture doesn't line up. Why are stocks going higher? Right? I mean, coming out of last March.
Oh yeah. I mean, the market predicted that COVID wasn't that bad, right?
And now we've got into 2021 where, the high expectations for earnings season to be another blowout. And I'm not saying it won't be. I'm sure it will be. But there's such good macro tailwinds we've had for the last 6 months. And now that camp is wondering why, well, shouldn't say stocks, most stocks haven't done anything all year.
Mm-hmm. I think the beauty of studying price is that it's a future discounting mechanism, right? That market participants are weighing the possibilities 6 to 12 months from now for companies, for economies, for societies. And just like people couldn't understand why the market could rip higher in April of 2020 underneath quote unquote a COVID and just terrible unemployment numbers.
I'm sure they're worrying about the 2024 presidential election.
Yeah, right. And so here we are. If we do roll over,
that'll be someone's story.
It would be someone's story. But if we do have some type of corrective action on our hands, it's going to be interesting to see what the media tries to label as the issue. And because we know that price moves first, news second, all we know are the facts that on hand. Like whenever you read a news article, as soon as you read an adjective, you need to understand that it's an opinion. Whereas the market,
that's a good point.
The market's the market. We can't sit here and tell it what to do. Price is price. It is the final arbiter of value. As fun or not fun as that is, right? Because we can be as thin as you want. And really, I should clarify, I don't get to, it's not fair for me to sit here and say the market is the S&P 500 and the market is the NASDAQ 100. Those are the two areas that are the strongest right now, that are hiding a lot of carnage underneath.
Well, I mean, I think for us that we can, I mean, if that is what benchmark you are going to compare yourself to.
Right. But it is also fair to say the majority of stocks are not doing what the S&P 500 is doing.
No.
And so you have to have a process for identifying that environment, right? Because we've gotten narrower in our own allocations, and that's not a recommendation. Everybody's a big boy who's listening to this or big girl. This is not a recommendation, but we've gotten narrower as the market's gotten narrower, because that's where the strength is. How many charts do we look at? Oh my goodness. Or ETFs, and we're looking at them compared to the S&P 500. What was it, just a day or two ago? We're sitting there going, none of these, that there's nothing that is beating the S&P 500.
There's nothing that we don't already own. I mean, which is large cap growth that now, and maybe that changes today. But correct. As of yesterday's close, where else do you want me to be other than huddled up against, or us to be the
warm fire of the S&P 500,
or these, Costco, Pepsi, Waste Management? I mean, those are pretty quote unquote safe names.
Oh yeah, garbage,
Visa.
Yeah, like you're gonna still use your debit card. You're still gonna have garbage. You're still gonna buy your staples. Absolutely. Yeah. There is definitely some risk off behavior going on right now. And I know we got accused 2 podcasts ago of being, wow, you guys are a little bit bearish. Well, yes, because some of the information that's going on underneath environmentally is important and you need to pay attention to it. Now, are we allocated bearish for the last week? Not necessarily, for the last few weeks, not necessarily.
No, because as trend followers, the trend is still up.
Right. You just might be narrower. Like you said, you're huddled up against the fire of the S&P 500, which is warm, while everything else is cooling off. And do we see the S&P 500 also cool off? Because eventually you run out of wood. There's if Apple and Microsoft and Amazon, Google, Facebook can't continue to be the wood of this market, then we do have issues and problems on our hands. And I don't want to sound like super dramatic when I say that. If we get the S&P correcting 7%, I don't want to sit here and be like, oh man, this is crazy. No, that's normal market behavior. And we want to pay attention to it
3 times a year.
Yeah. Now, do we get a 20% correction? I don't know. I mean, tell me once we cross 4066, 4067 on the S&P 500. If we cross below that, then that thesis is definitely on the table. Who knows? I only know 2 people know, the Lord and the market.
I mean, the VIX hasn't given any major, I mean, it's had a couple one-day attempts, July 8th, June 18th, even back in May, early in May, and they fizzle after a day.
Well, and
fizzle
and
intraday.
The possibility still exists that we see a return of participation, and that carries the market higher. And that's that whole rotation as lifeblood carries the market higher. So if we're above 43.20, 43.16 area on the S&P 500, and we start to see broad participation again, man, that goes back to your first point. This market could be 2017 type numbers to the high side.
Yeah.
No idea. Or broad market catches down to the lack of participation, and that's our answer too. And it's interesting to note, I know a friend of ours that we're going to see this week, and we're getting excited because we have our lunch and learn this week for our clients, which is an awesome event that our clients come and we have good food, good drinks, and we talk markets. I mean, what gets better than that? Dan's going to stop by, and I know he shared some really good charts a day or so ago just about seasonality. And there's some mid-July here, end of July is an important period of time from a seasonal perspective for many, whether it's the S&P 500, NASDAQ 100, you name it. This is an important period of time. We don't get to be surprised if the market does move lower from here from a seasonal perspective. And I know he shared those. So I'm excited to see Dan. It's going to be great to have you out here, Ian. We're going to put on a heck of a presentation on next Wednesday. We'll make sure to throw that on YouTube. There's another exciting announcement we have. Do you want to handle that one?
Yeah, I think so. Just wanted to say a big congrats to, as you guys know, we do have a reason before I get there. Kevin, our research analyst, as you guys have heard us talk about many times on the show, does a lot of work. He is the man in the turret when it comes to trading, and great news on his behalf as an aspiring technician and a great technician so far, but an aspiring chartered market technician. He passed level 1 of his CMT exam.
Yeah, it's a big deal, man. Like past level 1, we knew he'd knock it out of the park, which he did. And now he's going to go on to level 2. And obviously it's not the full designation, and we'll have a huge celebration when he does that. But it's a big deal.
Got to pass level 1 to take level 2, right?
Exactly. It's just like price. Yeah. It's math. It's math. And Kevin knows that. Kevin's a all-star on this team, and we love him. Does great work for our clients. But congrats to him for passing the CMT level 1 test. 2 more to go. I know he's going to rock those out too. And Kevin's such a humble guy, and he might not necessarily, be too stoked about us talking about this, but I think it's worth acknowledging because it's not everybody who just goes and pursues their chartered market technician designation.
It's a big deal. Got it on his first try. I mean, it's definitely something to be applauded.
Yeah, absolutely. And it only makes us stronger. It makes our clients stronger.
Coming off, and he just passed his Series 60. I mean, 2 for 2.
2 for 2. The dude's a beast, and it's good for our clients. We head down the road of having more guys that are experts at, or ladies that are experts at studying supply and demand and understanding the intricacies of science versus art in that process. It's huge. It's huge for our clients. It's what's in the best interest of our clients, and I'm excited for him. He's got a bright future ahead. So very excited about that. I think that's a great place to wrap up the client portion of the podcast. to summarize, we continue to see a thinning market. We've had a couple corrective days here, nothing dramatic, quote unquote, yet. Does that come to fruition? We don't know. But as Ian has alluded to, you got to use math to get to those levels. So if S&P 500 is going to stay above 4320, great. If not, the thesis for a corrective market is upon us. Ian, anything you want to wrap up with before we close down the client portion?
Here on Friday, markets continue to move lower. The broad indices, actually a real nice gap up for Russell this morning. I think it's got to save itself. Now, can IWM go down to 210? Yeah. For me, I mean, now we're kind of teetering on also being below 30 on a daily RSI. I think Russell holds the key to everything. It's the only thing that can fix participation.
Yep.
And it's got to start trending up. Now, it can underperform and
Right.
still fix breadth.
Right.
That's fine. We can fix a lot of issues with stocks above the 20, 50, 100-day moving averages. And Russell can still underperform, but it does actually have to perform.
Correct. It's got to be in an uptrend. And if we're going to close at a new weekly low, that would be the very definition of breaking that range and lack of participation. And we don't get to sit here and say, oh, we didn't see this coming, when IWM can't get above 234 and it's breaking below 217. That's important information. We got to pay attention to it. And there's only so much these mega cap names can do. We'll see. And that's the beauty of markets, is each week we get new information. We can make adjustments on that information. But your point is extremely, extremely important. Small caps carry a big key in what's going on here, because we know you look elsewhere and it's either US or not. Like, you're not sitting there messing around with a lot of international spots in the market.
And Indian small caps, and that's the only pass I'm giving to anywhere outside the US borders.
Yep, absolutely. And so small caps are a big key. We're below an important weekly level. On a daily level, if we're below 211.80, that's important. And so we'll see. Each week gives us new information. And when we see consolidations and ranges like this, which is what IWM or Russell 2000 has been in since the beginning of the year, is this a pause before moving higher? Is this distribution? And we're going to get
maybe all the large caps are early. I mean, right? You had Amazon make all-time highs April 15th, 2020. Right? And then consolidated right? And now it's made all-time highs, like a week or so, maybe like 10 days ago, back in July 7th, 8th, somewhere in there. So maybe I think small caps play catch up.
They could.
And other stocks, they play catch up again.
But I think you bring up a good stock as a barometer here. And I say that because they did break higher out of range. So like you said, are they the leader? Which they could be. Or if we see Amazon below 35.20 and we see small caps below 217, I think we need to sit up and pay attention and not be super aggressive stocks at this point. Because if your all-star of the all-stars can't keep it out of its range and has what quote unquote a false breakout, and IWM is not going to participate, that's going to be a little problematic for the market overall. So I think that's a great point. Small caps, Amazon, those are two things you can look at. Again, not a recommendation. You guys are adults, but those are two things you can look at that can give you pretty good clues on the market environment. Great points, Ian. With that, I want to pause here before heading into the extended portion. Thank our clients. We love everybody that's listening, the great feedback that we've had, and we'll do it again in a week.
Have a great weekend, everyone.
All right, Ian, jumping into the extended portion of the podcast, we're going to get some weekly closes on our hands here. We talked about 217 being important on something like small caps. Lots of other areas have been in corrective mode for longer than that. What are some techniques we can use to help us identify maybe how to mitigate if there's an incoming correction, which a lot of areas are basically under right now. But if that were to deepen, what are some ways we can mitigate that?
Well, you can always go to cash.
Yep, cash is a position too. I love it. It's not sexy. People don't like that.
It's sexy when it's May 9th or March 9th, 2020, and
yep,
you've been in cash for a week.
Yeah,
and your clients aren't stressed.
It is.
Obviously, shorts, and something that I feel like
summer shorts
as opposed to winter shorts.
Yeah. It's hot out.
One area I feel like we've worked on recently, and I think it helps from a neutralizing exposure and risk as much as you can. But I really pair trades. It's not something we talk. I guess sometimes on Twitter we talk about them. I wouldn't say it's like our forte.
Well, I would say, I don't think we sit there and post about it nonstop, only because they're a little more nuanced. And sometimes you bring up this idea to people, and for some, their eyes roll back in their head. And all it is a relative trade.
The thing is that you still have to outperform your benchmark, right? So the pair trade still has to, the spread from that still has to be better than what your benchmark's doing, which is a kind of another added layer of trickiness.
Well, and that's why you have to be careful with it, because more is not necessarily better. Complex is not necessarily better than simple. And so there's a time for them. There's a time for pair trades, and they become pretty self-evident. And all they are is just taking a ratio chart and comparing it to the S&P 500. Like, let's not make this more complicated than it is. It's taking S&P versus XLK and then putting that against the S&P. S&P versus technology, and then comparing it to the S&P again. Gives you an idea of, well, should I be long S&P, shorting tech in order to perform the S&P? So basically, I'm cutting tech out of the S&P.
And a lot of these, you can hold, for example, long utilities, short energy, or long tech, short banks. You can, have been able to, let's say in a March 2020 or a Q4 2018, even though broad stocks have been moving downwards and utilities were moving down, that paired trade still outperformed the S&P because your denominator is underperforming by enough to offset all of that.
Mm-hmm.
It sounds complex.
It's really not.
If you do it on a chart, I feel like it would make more sense.
Yeah, pull up a chart of S&P versus IWM versus S&P and look at it on a weekly time frame. You'll notice that, wow, it looks very similar to the inverse of IWM, and you would be right. And so it's basically confirming to you that you can have a low risk short on small caps, which you can use on an absolute basis. Look at IWM and just say, okay, back above 217, that thesis is wrong. We can be short small caps below 217. Above that level, that thesis is wrong. Now, don't go out there. If you're listening to this, I don't know your situation. You go out there and short small caps and you lose your pants, that's on you. Because if you're not using proper risk management, that's your problem. We can handle that in-house here, no problem. But just going through that process of one thing versus another versus the S&P, to your point, beating a benchmark, that's one way you can do it as pair trades. And that helps. And it's almost unlimited. It's obviously not unlimited on the amount of pair trades there could be.
Mm-hmm. Yeah, exponential.
And it could be as simple as, if you wanted to be long Bitcoin, can you hedge by using a short of small caps?
Long staple short regional banks.
Right.
And outperform the S&P. Absolutely.
Yep. There's all sorts of opportunities like that.
in a lot of these risk on, risk off pair trade relationships, and we had Pratty run through a lot of these. I've run through some of my own. Had Pratty do more of a deep dive.
Well, it's the same process that allowed us to be short small caps in late 2018. I mean, once you started running small caps against everything, it became very apparent that that's where the short was.
Well, and look at some of these bases now in these relationships. Look eerily similar to middle of October 2018 or late February 2020. And, maybe they fizzle and nothing happens. But it seems like it's very, very similar behavior. So just something to ponder as, again, I'm not suggesting that this is for everyone. We have a team here, like Dave said, we have a team here that can pretty much monitor anything on an intraday basis. So.
But they're extremely useful tool.
They are.
And you can close that short in a couple of days, neutralize the other position, the risk part of it, and leave that.
And then keep your long.
And then keep your long.
To outperform.
Right. So it is a powerful tool, and we can dig more into that in other episodes.
But think about that. If you are fifth now, and this is definitely not saying that this is appropriate, but I'm just saying this from a theoretical math perspective. So if you're 100% long utilities, 100% short energy, in theory, your equity risk is zero. Now, I know that there's probably quants out there that would totally trash that, and they've got to throw around a bunch of math and prove their point, and I have no doubt. But I'm saying from an exposure standpoint, maybe exposure is a better word to use there. It's still zero. So you could beat the index. You could beat your index with having zero net long exposure.
Right.
That's powerful.
That is powerful. And you can, and going back to your original point, you can also keep it more simple and just own cash. If the dollar is outperforming the S&P 500, if you should, not a trade weighted dollar, but if you should own cash over the S&P 500, then do that. And in a lot of instances for the past 3 months, all we've been seeing is sectors and subsectors and equal weight and small caps underperforming cash, but not necessarily on the mega cap level. And that's what continues to.
Not on the mega caps.
Yep. Not on the mega cap level.
I will say some of them that were helping hold up really ended up having, some of the banks out there, like your big ones, JP Morgan, Bank of America, just, I don't know. I wish I had better news to talk about on here. Dave, I wish I did, but I know I can't make up my own fantasy.
Well, I know. And an area that we have talked about in the past, and it was being led by NVIDIA, which is now, almost 15% off the highs. It's high.
In what, for, a week, 2 weeks, probably 2 weeks, week and a half. That was quick.
And SMH is back. SMH now is in failed breakout territory. Never got overbought RSI. We're now below 256, 257. We've talked about that price level before. We're below that. An important piece of semiconductors, Micron, looks like it's on the verge of confirming distribution.
It's going to be real. It's hard to create a bullish thesis around semiconductors if Micron is below $77.
Right. If we've got semiconductors underperforming, selling off, and they have divergent highs on a relative basis. So you compare something like SMH by itself and S&P by itself, but then do SMH divided by S&P, and you have that pretty good divergence that goes back all the way to February. we're breaking below important levels. This is a bellwether area. You combine that with what we talked about with Amazon and small caps, and you do not get to be surprised if the next couple months is ugly is too strong of a word, but if it's a downward market, you don't get to be surprised by that based on this.
I'd say wonky, but I mean, we've had a wonky market for 4 months. So
right.
Look at something like FDN, internet stocks.
False breakout.
Clear failed breakout.
Yep.
Above 245. Clear broken rate of trend.
Mm-hmm.
The May lows. This is what you're seeing on an absolute basis across even the best. I mean, internet's been one of the best areas, right? I mean, it's still outperforming since those same May lows.
Right. And you have other risk off warning level, like junk bonds versus IEF.
Yeah.
You know, IEF being, you know, some would argue that that's okay comparison because that duration is shorter, 7 to 10 years. But you just take a JNK versus IEF, and you got to ask yourself as a technician, did we just retest the underside of a neckline on July 13th and now we're selling back off, which is completely risk off type behavior in junk bonds?
I mean, I feel like that's clearly an uptrend with, you know, a consolidation, and now, I mean, broken rate of trend again.
And
just another crack in the foundation.
Yeah.
And even if they get it back above this neckline that you are mentioning, I don't have great math on my trading view. I don't go out enough decimal spots, but 0.95.
Yeah.
0.945. There's still enough to bounce this, right? Because we've talked about this. There's still enough, as bad as some of the charts were this week. Now they've made room for themselves to bounce, but still have not fixed anything.
Right.
Especially on a relative basis. So also something to be prepared for, right? Because counter trend moves and downtrends are, I mean, they're pretty violent. Pretty big.
Yeah. They're pretty violent. You know, we saw
that last March. I mean, how many? Yes, I think everyone remembers the circuit breakers, but we had multiple 4, 5, 6% up days.
Oh, absolutely. And you know, you don't get to, like, even if you look at like the 2008 to 2009 correction, you had pretty vicious rallies that just continue to get amplified. You know, you're talking about plus 9%, plus 13%, plus 8%, plus 19%. All this is happening on the way down, plus 25%. But yet we're still making lower lows. That's all happening in a downtrend over 18 months. You get sequences where you have these very quick, violent counter trend moves. And we could get that. We could get that in some of these relationships, some of these absolute names.
So your last two big breakdowns, coincidence, I think not, going back to some dates we mentioned earlier, were in the junk high yield versus intermediate term treasury using J&K versus IEF, February 26th, 2020. And you could say October, you could say November 2018.
Yeah,
we'll go. But the point is there, Q4 2018. So I'm not saying it happens again. I think you kind of joked earlier and I know even my mom texted me. She's like, gosh, you guys are bearish. Not bearish, skeptical for sure.
We're just presenting the data, you know, and right now it looks like construction signs everywhere. It looks like we don't need to be driving 70 miles an hour in this. And, you know, when the majority of the cars have the brake lights on and there's construction signs everywhere, I think we should slow down, right? I think anybody listening, based on that data, you know, you're your own advisor. You know, I can't sit here and tell you what to do. But when you have all these warning signs for us and for our clients who we know, we're not going to be driving 70 miles an hour. That doesn't make sense.
Well, and so here's the thing with this high yield versus intermediate term treasuries relationship is, and at least the one I'm explaining, this is not dividend adjusted. This is strictly price. So we're taking cash flows out of it. I mean, we can be in a continued downtrend. Now, some of the best markets are when we're in uptrends, 2020 into 2021, 2016 into 2017 to 2013. But at 2014 to 2015, 2011 to 2012, 2019. I mean, yeah, did stocks go up? Some did, but those were rough environments.
Yeah, stealth bear market environments where there were some areas.
2015, 2016 was, I know it'll never be looked upon in the history books as anything spectacular. That was a rough market.
Yep. Underneath the water, definitely a stealth bear market. And you could argue that in that environment, that's when we kicked off a new leg higher, right? The first school of thought being 2013 was the break above 2000 and 2008 highs.
Yeah, that was the big generational breakout there.
Right. That's the beginning of our bull market. We get a cyclical bear in 2015, 2016, and then we rise out of that. Now, we've also had 2 20-plus corrections in 2018 and 2020. Typically, we're seeing those every 4.5 years, 3.5 to 4.5 years. We had 2 and 20-some months. Now, we'll see. We'll see what goes on here, but we know that markets don't go in a straight line. They do what they do best. They fluctuate, and they have corrections in the middle of, not exactly in the middle of the year, but we've got some seasonality coming up, weakness now through October. All the pieces are aligned.
Typically, October kicks off, your most bullish monthly run of Q4 into January.
It's kind of like watching the team drive down the field and they're inside the 5 with a first down with a dominant offensive line and a great running back. And you ask the question, are they going to score? I don't know the answer to that, but it sure looks good.
Yeah.
And we've seen the Bears fumble it before.
Golly. They do. I mean, again, it's not like Bears they've chiseled away, but haven't done anything yet.
Yeah.
And going back to that change in behavior on the Russell 2000 weekly candle, we did get it. They did not bounce this afternoon.
They did not bounce it this afternoon. And I think another piece of the, construction sign, warning sign puzzle is when we look at it in volatility using an instrument like the VIX and compare it to the volatility of VIX. So using VVIX, and comparing it, not in a ratio, but just looking at the charts side by side and seeing that the April 2021 low, the VIX made a lower low in June. Meanwhile, VVIX did not. We made a higher low. And that's some of this type of similar behavior you see before bigger pullbacks.
Yeah,
doesn't have to happen. That divergence can last a while, but it's there.
It was there in 2020.
Yep. 2020, 2018, pretty big divergence there. Before Volmageddon.
October, yep.
So it does happen. It does take place prior, and it can last a month, 2 months. So we'll see. We'll see what happens if we continue to get a pullback.
It diverged. 2013 is one of those strong, steady years.
Yep.
So certainly an interesting relationship.
And then when you look across the whole spectrum of stocks, it's not just a stock market, it's a market of stocks, whether it's small caps or equal weight. We look at so many ETFs and they're all underperforming the S&P 500. It is.
And I think it goes to show you how much Amazon, it's just more further proof. And people think that it's on the surface, it sounds silly when people talk about, 6 stocks are holding up the market. Also, I don't like to say this because it has been such a flawed market. Like a lot of people tried to use that in 2020, and that was not the case. It was not mega cap tech holding up the market in 2020. Now, I think it's so clear that is the case.
Right.
Because like you said, so micro caps, that's, 3,000 stocks. how many? Maybe that's the worst of the worst. The most either risk on or risk off. That's your extreme.
Right.
Smalls. That's 2,000, or at least let's use the Russell 2000. That's 2,000. Reverse weighted. So again, you're taking the smallest cap weights and making them the largest weights in an index, or an equal weight where, all 500 stocks are at, I don't know, what is that, 20 basis points of position. And they're all, like you said, underperforming. Again, I think that's a great example of breadth.
Yeah.
I mean, it is narrow.
So narrow.
It is narrow.
And you even have the Dow Jones now recording a false breakout on a daily time frame where we broke above 34,750. We're now back below that with a pretty big RSI divergence going back to April. You have these things that you're pointing out with micro caps, small caps, reverse weighted, equal weighted, all underperforming, narrow. We maybe had a shot back on July 9th with a 90% up day. But then you look at what we've done since, and it's been anemic. Like today was Friday, July 16th, 17% up day.
And so we had the 90% up day on the 9th.
Yep.
Yeah, I was really hoping that was going to kickstart the engine,
and since then, the highest upside day we've had is 53%. Then we had 24, 40, 38, and today 17. So it's been pretty anemic. And meanwhile, it is notable to see treasuries up.
Treasuries up.
Now, this is an important level because we've talked about a falling 200-day moving average. We're right at that level. We've talked about the peak going back to August, September 2019. Do we clear there? That's to be determined. It's not just a blind buy at this point. It's all about asking yourself the question, is this where we're going to put new money to work? And you just have to be careful and know your time frame and know when you're going to do those type of things. But it is noticeable that, okay, let's talk about safety. Like where do asset managers go for safety? Well, treasuries has typically been one.
Well, most don't. That's their diversification is supposed to be their safety.
Right. Yes, good point. Fleeing to the Japanese yen is something that we can typically see. Mm-hmm. And right now there is a short-term rate of trend that's been broken in the US dollar Japanese yen relationship. Another one is gold, but I'm not seeing what you would normally see from, I don't think you hide out in gold here.
I'm certainly not holding out in the miners. Like horrible. They had a horrible day today.
Yeah.
And fact, if anything, that's a broken, it's a sideways uptrend. I don't know.
Yeah. What interest?
Really bad.
Yeah. What instrument are you? Can you give an example of that?
SILJ.
Yeah. So like junior silver miners, correct.
Right. And if you're going to buy, if silver's going higher, I bet they're going to buy, and we're serious about silver going higher. Junior silver miners are probably going to lead that. So the fact that they're breaking down, I don't think people are going to run to precious metals. Maybe that's a silver lining in all of this.
Mm-hmm.
Or maybe just gold's not the safe haven that it was for 60 years.
Yeah, because more recently for the past month, we do see staples outperforming. We do see utilities outperforming. We see treasuries doing better. Those are risk off. But to your point, we're not seeing the same thing out of GLD. And the yen hasn't gotten away yet, but maybe it will. It did break an important rate of trend.
Maybe this generation, gold doesn't carry the same, what's a good way to put this? The same weight in regards to, for lack of a better word, safety,
right,
as previous generations.
Well, remember during the panic crash, and people need to remember this, is that when things start getting liquidated,
it doesn't matter.
It doesn't matter. Like we had negative oil, we had gold getting sold like crazy. You name it, treasuries just getting slammed do you have a process? Do you have an asset management firm that is able to get you? Because, right, that's not diversification because they're all carrying the same risk then. The academics would say, oh, you need to diversify away risk. Well, how are you diversifying away risk? Go look at the panic crash of 2020 and tell me how diversification reduced risk in your portfolio. It didn't. So, you
that's a great point.
You can't just blindly hold something because that you're somehow diversifying it. But what if everything becomes correlated? Which it did then. Everything became correlated and dropped together. So
when people just want cash in their portfolios, fundamentals absolutely go out the window.
Right. And you start
macro, fundamental, hide cash under your mattress type of thesis. And right, I don't know, maybe, right, is Bitcoin? I mean, we haven't seen people run into Bitcoin, right? So quote unquote digital gold hasn't perked up either. Now it hasn't broken below 30,000. I think below 30,000. Definitely bad news for the crypto arena. But I mean, I think it makes a good point. I think both of them are just whatever you want to make of them. You can't, in fact, I even read it or was watching an interview earlier today of, you can't buy anything with crypto. We kind of joked about this with gold last. I mean, it's the same thing with gold. Like, is it something you want to have when poop hits the fan?
Right.
Like, are you buying bread and milk with your Bitcoin app at the grocery store?
Yeah. Is that gas station owner?
I'm pretty sure in 2008, you weren't walking into the grocery store with gold bars to buy food for your family. It's just so funny to me. The people build up these ideas of store of value, and yeah, maybe it is on paper.
Right.
But
if you're a doomsdayer, like, why gold bars? Why Bitcoin? If you're a doomsdayer.
Why Bitcoin? So if you are
I'd rather have a Tupperware container full of bullets, cigarettes, and deodorant. You know how much bartering I could do with that?
I mean, that would be personally way more valuable to me than your digital currency sitting on a computer that may or may not be accessible.
Correct. It's what makes these conversations so interesting, right? Because we're conceptual human beings. What sets us apart is that we have consciences and we can conceptualize things. Now,
do you think it's easier for technicians who I would say have a more literal view of the world to separate themselves, right? Because it's just a trade. Bitcoin to me is just a trade.
Correct.
It's just a trade. Now,
right.
Are there some long-term and yes, personally, there, could it be a long-term investment? Yes. I don't own any Bitcoin right now, which has been a good call since below 45,000. So, I mean, maybe I take that back. Maybe even personally, it's just a trade.
I think we as humans love to create stories that we can attach ourselves to that make us feel good.
And it's able for you to justify holding things, whether in their uptrend, downtrend, underperforming, whatever.
And there's so much that goes into that, even the machismo, right? Like, look at me, I'm hodling, look at me. I'm not letting go of this.
Gosh. As if that makes, right?
That's like frontal lobe teenager type. It's the same type of attitude that gets teenagers to jump off of bridges into water that they shouldn't. That gets kids hurt. It's the same thinking. Look at me, look at how tough I am that I'm holding on to this. Same thing. You see it out of... I
don't even care if I lose money, right? I don't even care if I get hurt.
Right.
It's unfortunate that they're doing it for the quote unquote in the name of sticking it to the hedge funds.
Guess what? You're not sticking it to the hedge funds.
You're not sticking to the hedge funds, guys. You're not.
So, no, that's good stuff. And
go raise $8 trillion, and then we'll talk about sticking it to hedge funds.
Right. Exactly right. There's trillions and trillions of dollars being moved around.
They've got you playing in the palm of their, I don't know. I won't go any further than that for the sake of upsetting people, but
It's a market of supply and demand.
I had to admit that I'm not as smart as I think I am when it comes to the market. And I think there's a lot of people out there that probably need to do the same.
We are a prideful bunch. We marry pride pretty hard. We really like ourselves. And the sooner you become aware of how fallible I am, the more I become aware of that. Now, not from I need to get depressed about it because I have a savior that covered all that, but just the fact knowing that I'm fallible and that many times there's heuristics and there's biases that take place that create a fog and a mirror and smoke that doesn't let me see the reality. And that's what makes price so powerful to me, because it is the reality. There is no getting around what price represents. They settled on the price of the S&P 500 today at 43.27. That's a fact.
Yeah.
I don't get to go around this weekend and tell everybody, well,
stocks are worth something else.
Right. Because that's what they actually did agree on.
The S&P fairly valued is 3,800.
Right.
No, the S&P fairly valued is
43.27.
43.27.
Yep.
Sorry, to bust your bubble.
Yep. And that goes back to that,
And yesterday, you know what? At yesterday's close, do you know what the market was fairly valued at?
At yesterday's close?
43.60.
43.60. Price is the final arbiter of value, whether you like it or not, whether I like it or not. And the sooner you marry price and divorce yourself from your own opinion, the better off you're going to be able at managing risk and participating in uptrends, even when breath is terrible, but also identifying when that is and being able to protect below certain price levels, the better off you're going to be. Because if you've been out since the election, just because you didn't like the dude that got elected.
Some people have been out since the election 2016.
Yes. You can't do that. Price is price. So that it's what matters most. It's the opinion of the masses knows more. The culmination, the manifestation of opinion is price. Not participate
more than Paul Krugman.
Oh, that's good. I feel like we got.
I remember when he went to all emerging market, or he said he went all emerging market or foreign stocks, like in the beginning of 2017.
Yeah,
because of the election results.
Yep, and I get it. We all love having opinions. Like it's fun for me. I like to
kill. Now, I'm not saying Paul Krugman's probably worth millions and probably doesn't give a crap about my opinion about his equity portfolio.
Well, he's probably a smart dude. There's lots of people that are way smarter than me.
Does an average American taking that same approach? So you're willing to sacrifice potential wealth creation and furthering your retirement and building safety in your financial, in a financial sense. You're going to risk all that because you have an opinion about some dude that got elected as president? That sounds insane to me.
Right.
Yeah, I got opinions about the guy that just got elected in November. I got air quotes around elected.
Right. I love it.
And guess what? Do
you know what our political position sizing in our portfolio is?
Like
0.
Negative 30.
Yeah. There's no political position size in our portfolios ever. We're not long politics ever.
Not long stories.
Right.
Not long theories. Not long this doesn't make sense or this should make sense. It'll make sense if this happens. Like, not long any of that.
It pays to use price. And that's what we're going to continue to do on the adaptive team is focus on price. And if we're below 43.20 next week, we're confirming that sellers have control of this market for now. If not, let the uptrend continue. With that, Ian, I really appreciate you joining me on here. I know you've been under the weather, so this means a lot. You do a lot for our clients, and that's appreciated. It's not always easy to show up and do what's required when you're feeling like crap, so I appreciate it. Thank you for doing that. To all those listening, we appreciate you guys. Interesting week this week. We'll cover it again next week. See what they bring.
Have a great weekend, everyone.